Okay, it's a few minutes past 9, and I see we have a good number of attendees having filed in. So we're going to go ahead and get this rolling. So welcome everyone to Lauterbach and Amon's annual Payroll and Taxability Training. As the title implies, we will be covering a variety of payroll topics with an emphasis on the tax side of things. I will introduce our panelists for today. My name is Tim Gavin. I'm a principal here at Lauterbach and Amon. I've got over 15 years working with government entities, both as an auditor and a consultant. I work with our payroll services division and a number of our financial services clients and a little bit in audit as well. I'm joined by Wes Levy. He's a director here at LNA with over 13 years of experience, also serving a variety of government sector clients. He manages several of our financial services engagements, also has a focus on payroll compliance, budgeting, forecasting, and software implementation. And finally, Erica Smith. She's also a principal here at Lauterbach and Amon. She's got over 10 years experience in the government sector with a large amount of time spent in municipal finance. She currently serves as a finance director for one of our villages. The agenda for this morning, we basically divided the presentation into 3 sections. Fringe benefits and taxability is going to be covered by Erica this morning. Then I'm going to discuss some of the common payroll forms, including 1099s, which are vaguely related to payroll, including some important deadlines and some reconciliations that are helpful to those preparing. And then Wes is going to round out the morning session by covering some miscellaneous payroll topics, including some key updates to some legislation and regulations. We will be taking a break about halfway through. So we know a 2.5-hour session is a nice length of time. So we'll give everyone a break about halfway through. As we are using a webinar format this morning, we are happy to take questions. In fact, at the conclusion of each section, we'll have a Q&A segment. Please use the Q&A function in Zoom and submit all your questions. That way we can keep track of what we've answered. Excuse me. If you submit a question via chat, there's a good chance we won't see it. But that being said, if you are having any if we find there's any significant issues with audio or video, please let us know in the chat. But otherwise, we'll be monitoring the Q&A for questions that come through. That being said, this is payroll is a vast topic, and though we have 3 experts on this panel, there's a good chance there may be a question or 2 that we are not able to answer or might require some more research. So we'll be keeping track of questions that perhaps we can follow up with after the session. So please keep that in mind. That rounds out the introduction. Without any further ado, I'm going to pass along to Erica to cover our first section.
Thank you, Tim. Okay, can everyone see the presentation?
We are seeing your presenter view, Erica.
Let me see. Stop sharing. Sorry. Give me a second to. Okay, can you see it now?
Looks good to me.
Okay. Good morning, everyone. My name is Erica Smith, as Tim introduced me. I'm happy to be here participating in one of our most popular trainings. I know that I have some big shoes to fill in going through fringe benefits and taxability, so we're going to jump right in and I'll do my best to answer any questions you may have as we move along. The taxability of fringe benefits. What is a fringe benefit? Fringe benefit is a form of pay that is generally taxable. This includes property, services, cash, or cash equivalents like gift cards and gift certificates. These items are taxable, meaning that they are subject to federal and state taxes as well as FICA, which includes Social Security and Medicare. You may be wondering, are there any fringe benefits that are not taxable? The rule of thumb is to assume that a benefit is taxable unless you can prove otherwise. So what fringe benefits are excluded? De minimis fringe benefits are not taxable. So what is de minimis? What's the limit for it? Well, generally the IRS does not define a specific amount, but it's generally $25 or less. Non-cash achievement awards are also excluded from benefits. However, certain criteria must be met. You must have at least 5 years of service. You cannot have received length of service rewards in the last 5 years, meaning you can't get one every year. And these are items like gifts that may be presented to employees to thank them for their service. It's limited to $400 per employee per year, and it's presented as part of a meaningful presentation. It also can't be a method disguised as pay. Cash. So a lot of times people will call me and reach out and say, well, if we give a gift card and it's only this amount, it's only $10 or $15, do we really have to tax them on that? The rule of thumb with cash, it's very easy to remember. It does not matter how small the cash gift or gift card or gift certificate is, it is always taxable, and it is no amount is considered de minimis. Now we'll move on into other taxable fringe benefits. This includes car allowances, uniforms, no additional cost services that may be offered to employees, which we see typically in park districts, tuition reimbursements, wellness program benefits. We're going to dive into each one of these in more detail. So car allowances. Car allowances and employer paid vehicles are what we're going to talk about first. Car allowances are funds that some employers give to their employees to account for travel that they may do in their personal vehicle for work. Car allowances are subject to tax. They are not subject to IMRF unless employers have a board-approved resolution on file with IMRF that allows taxable fringe benefits to be included. There has been an update, which I know we reviewed also during the training last year. That update was effective August 25th, 2017, where for new employees, employers can no longer include car allowance in IMRF through resolution. So some employers may provide their employees with an employer-provided vehicle as opposed to a car allowance. So you allow an employee to take home a vehicle for business use. Employer-provided vehicles are subject to taxes. They're also subject to IMRF. There are exceptions to this rule. If the vehicle is clearly marked police and fire, is a clearly marked police and fire vehicle, it is not subject to taxes and IMRF. Unmarked vehicles used by law enforcement officers are not taxable if the officers driving the vehicle are authorized to carry a firearm, execute search warrants, and make arrests. So how would you calculate the taxable value? There are 3 methods that can be used, which include the automobile lease value, the commuting rule, and the cents per mile rule. I'll go over each one of these. However, IRS Publication 15 includes the rules for each of these methods. The first one, the automobile lease value method, is one that's most widely used, I would say. For this method, the taxable value is calculated by determining the vehicle's fair market value and using IRS Publication 15B to find the annual lease value. Once you have the lease value, you can multiply the percentage of personal miles driven by the employee. So let's go through an example. What does that mean? You have an employee that is provided a vehicle. And that employee, you determine by using publication 15 that the fair market value of that vehicle that you provide is $25,000. When you look at the publication, you'll find that a $25,000 fair market value is equivalent to a lease value of $6,850. If that employee's personal use of the vehicle is 20% of the total miles, the annual taxable value would be $1,370. In my experience, what people typically do is they provide a form that can be filled out periodically, I would say about monthly. And the employee can report the number of miles that were business use and the number of miles that are personal use. And then using that form, you would calculate how much of the monthly miles are taxable and include that on their paycheck. The next one is the commuting rule. The commuting rule is a method that is used when a vehicle is provided to an employee only for commuting to and from work. So you may have an employee who you really need to be able to come in after hours, maybe a public works employee or someone who needs to have a vehicle to be able to come in if there's something that they need to respond to or an emergency, but they're not a police or fire employee. To use this method, certain requirements must be met. The vehicle must be provided for business use, and you must require the employee to commute in the vehicle. You must also have a written policy under which you do not allow this employee to use the vehicle for personal purposes. So basically, they have to understand you're only providing this vehicle for a bona fide business case for them to commute to and from work. It is not for any personal use. The employee actually doesn't use the vehicle for personal use, and the employee is not a control employee, or in other words, a key employee. So what is a key employee? What defines a key employee? The IRS defines a key employee as someone who is an elected official or an employee whose salary is generally more than $130,000 per year. For this method, the taxable value is calculated as $1.50 each way, or $3 per day. That is the amount that you would include as taxable wages to the employee. And then the last method is the cents per mile rule. This one we don't see used often, but it's pretty straightforward. It's calculated by multiplying the standard mileage rate by the number of personal use miles. In 2021, the mileage rate was 56 cents per mile, and in 2022, the rate is 58.5 cents per mile. Let's talk about uniforms. So uniforms are not taxable unless all of the following apply. So there are three things. They must be paid under an accountable plan. So what is an accountable plan? An accountable plan means that if you pay for uniforms for your employees, they must provide a receipt. So if you give them a uniform allowance of $500, they would need to provide a receipt showing that they purchased uniforms with that $500 in order for, that's one criteria that needs to be met as far as taxability to determine if it's taxable. The clothing must have a condition that the clothing must be worn as a condition of employment. And then the last one is that clothing is not suitable for everyday wear. So this is the one that usually people can't satisfy when determining if uniforms are taxable or not. For example, if you give out t-shirts to public works employees, or maybe as a park district, your summer workers have to wear a park district t-shirt as a condition of their employment. Well, it's paid under an accountable plan as you purchased it and you have receipts for it. It's a condition of employment. However, generally a t-shirt, even with employer's logo on it, is suitable for everyday wear. So in that case, that would be taxable, unless of course that shirt is a de minimis fringe benefit under $25. Another one that we see is clothing worn by plainclothes officers. Those are taxable. And those are typically your detectives or people who you don't want, to be identified as law enforcement. One question that we received last year was about safety boots. So I wanted to throw that in the presentation to cover that under here. Safety boots are not taxable. They are specifically identified by the IRS as not being taxable. However, they must be paid under an accountable plan, which of course is that the employee has to provide a receipt. If employees are provided a boot allowance for $200, but they're not required to provide a receipt, that would be taxable just like other uniforms. No additional cost services. Typically, we see this within the park district industry. These services are excluded from income if the employer offers the service to its customers in the ordinary course of business, which usually it's use of like the golf course or fitness facilities, swimming pools. And if the employer does not incur any additional costs when providing that service to the employee, which also includes foregone revenue. So what does that mean? That means that if, for instance, an employer allows an employee to use their facilities, as long as when the employee uses the facilities, no, that's not, that's not taxable. However, if the employee has the ability to use the facilities at a prime time that they would have charged a customer, a higher rate to use that facility, then that might be taxable, because in that particular example, they would be possibly losing revenue if a customer would have been able to book that use of the facility. It could be like having a party on a Saturday for a kid at the park district or something like that, where someone else would have paid a normal customer would have paid a higher rate for that. So that's foregone revenue if you allow your employee to book that same facility at no charge. Wellness program incentives. So wellness program incentives, we see a lot. A lot of employers are offering wellness programs to get employees to focus on their health, get rewarded for maintaining good health, because this also typically, the healthier your group is, the better insurance rates that you get. We all know that. However, wellness program incentives are generally taxable. A lot of times the incentives tend to be cash rewards. So we talked about that already, that cash rewards or cash is taxable. It doesn't matter what the amount is. Sometimes though, employers may choose to outsource their wellness program or hire a contractor to manage or administer the wellness program. And then the contractor pays the employee or provides some type of reward to the employee. So you may think, well, the village or the park district or the school district didn't provide this, so it's not taxable. We don't have to worry about it. Well, you do, because the third-party vendor is considered by the IRS to be an agent of the employer. As such, you would have to tax that benefit. It is subject to federal taxes, federal income tax, FICA, and all FICA and employment taxes. Any reward not otherwise excludable from taxable income, such as gym membership fees, are taxable. And then last but not least, reimbursements of premiums if the premiums were originally made by pre-tax salary reductions through a Section 125 plan. So what does that mean? That means that if you offer some type of refund of premiums, if certain criteria are met within that wellness program and those premiums were paid pre-tax, that is a taxable fringe benefit. Leave donation policy. So over the last few years, I've had a lot of questions and done a lot of research on leave donation policy. I have notes in my files, and a lot of businesses, they want to offer their employees a leave donation policy, which allows for leave to be donated from one employee or from a group of employees to another employee who may be out of leave time. There are very specific requirements that must be met in order for the donation to not be taxable to the donor. So the last thing someone wants to do is try to help out another employee only for it to cost them to do that, cost them more than just giving the time, right? So what are those requirements? The employer must have a written plan. that includes the application and approval process. Typically, what we see is an employer sets up a team, or perhaps HR is designated to administer the program. And employees who have a need may apply to that program to request use of time from that program. It must also be used for medical emergencies or a major disaster. The final requirement is that the time donated must be donated to a general pool. So what does that mean? That means that you may have an employee, Jane Doe. Jane has ran out of time because she had an emergency, whether it be for herself or for a family member. She had a medical emergency. She's run out of time and she doesn't want to go unpaid. So you may think, well, I'll send out a communication and I'll let people know, because everybody knows Jane, they know what's going on and they really would love to help her. So I'll send out a communication to ask for people to donate time to help Jane. That's a no-no. You cannot do that. That is considered a one-to-one donation, and that would be taxable to the donor. What you should do instead is you can send out a communication, but you cannot name the person who it's for, nor should you give any other type of identifying information. If you're in an organization and everybody knows Jane in finance, because maybe your organization is small and everybody just knows what's going on in this situation, you can't even say we have an employee in the finance department or in the public works department. It has to be general. So what we typically recommend is that maybe you do a call for donations once or twice a year around the same time, just to allow people, if they want to donate to the pool. And it's a general pool, and therefore when an application comes in, there's time available. There's no need to send a communication out, because what happens when you do that? People start talking. Well, who do you think it's for? You don't want that. It has to remain anonymous. The other piece is that once someone donates time to that pool, it must stay in the pool. It can stay there for the next application, but it cannot be returned to the employees. The only way it could possibly be returned to an employee is if someone who donated later had a valid application that was approved to be used from the bank. So workers' compensation. This is one that we like to keep in just as a reminder. I think most people are familiar with it. And if nothing else, you probably have to deal with it, unfortunately, at some point, probably annually. So the Illinois Workers' Compensation Act provides workers with 66 2/3 of their salary tax-free. However, if that employee is a public safety employee, police or fire, those employees are provided 100% of their salary tax-free for 1 year. That is paid under PETA, the Public Employee Disability Act. It is not subject to federal, state, FICA, or Medicare taxes. And the last topic we'll cover under taxable fringe benefits are scholarships or fee reductions for programs. So scholarships are any amount that is paid or allowed to a student at an educational institution for the purpose of studying. Generally, this isn't taxable if the student is a candidate for a degree at an institution that maintains a regular faculty, so they have staff and faculty teaching, and a curriculum used for tuition, books, fees, or supplies and equipment. It cannot be for incidentals. In that particular case, it would not be taxable. Fee reductions include the cost or the reduction of costs for programming. So if you label a fee reduction as a scholarship, it carries no taxable component. Fee reductions for programs are not reportable to the IRS. This is also a question that we've been receiving more and more as far as the taxability of it. So, I'm sorry, guys, I went through the slide and didn't realize it didn't click. I'm sorry. So how to respond to the IRS. In the unfortunate case that you receive a letter for an audit from the IRS, the main thing that you want to do is make sure that you respond timely and ensure that you address all of their requests. You also want to make sure that you prepare all of the documentation that they have requested before they come out to the field to review your paperwork. For example, if your leave donation policy is being audited, you want to make sure that you have all of your documentation that shows your policy for the program, the applications that you've received, any documentation of who has donated, who has received payments, as well as just that procedure that proves that it is a general pool and is not one-on-one. However, let's say, for instance, after reviewing everything, the agent still feels that, well, your employees were able to tell that it was Jane Doe. And so going forward, if you continue or you don't make these changes in your policy, it would be taxable. You may get that, and that would be the best case scenario, or they agree with how you've handled it. But at the end of the day, you should always be courteous and attentive to their requests, because you want to make sure that you end on a good note, and hopefully it is not a negative experience and you can move forward and perhaps even use that person as a resource in the future. So here are some helpful sites to go through if you have any questions. I'm sure a lot of you or all of you have been to these sites and used some of these publications. IRS, the SSA website, and then the Illinois tax website, Department of Revenue. Publications, every year I go out and I make sure that I have all of the publication 15s to reference to see if there are any updates. Went through it as I was preparing and reviewing this presentation to make sure that there were no updates or no changes. It is a good rule of thumb to download those reports, save them every year so that you don't miss something. I know a few years ago, they updated the supplemental tax rate, and that's something that stays the same for so long, and then they may decide to update it. Another publication is publication 963, which is a document that covers federal and state government, local governments, and then publication 525, which covers taxable and non-taxable income. So with that, I will turn it over for questions. I think there are questions in the chat.
Yes, this segment always gets a ton of great questions. So we're going to try and go through one by one and hopefully get them all answered. But I wanted to briefly mention, we've gotten the question a couple of times of whether the slides will be made available. We will make the slides available following the webinar. So always serves as a great resource to refer back to. So I definitely look forward to that. I will start at the top of the list and we'll go down from there. So this one's referring to vehicles. If all miles are for business, are any of the miles taxable?
If all miles are for business, then no, it wouldn't be taxable. Only the personal use is taxable.
Okay. Very good. And in reference to wellness, would those be considered IMRF wages?
So that would depend on if you have a resolution on file with IMRF to include wellness benefits in your IMRF wages.
Okay. Very good. Is an employee discount on recreation programs taxable?
A discount is not taxable. Good question.
All right, excellent.
Let's see
if you donate the time, could it be classified as a gift tax as long as it isn't and it is under the gift tax amount, would it be classified?
Not sure I understand that question.
I believe the question is asking if you are donating leave.
Leave time, could it be considered a gift? Yeah. I don't think so. If it's considered a one-to-one donation, it would not be considered a gift, unfortunately. Okay. So essentially, it's 1-to-1, it's as if you received income and gave it to someone, so you would be taxed the income tax rate as if you received that vacation or sick time as paid out to you and gave it to the other person.
Very good. If you reduce the amount of employee premium for health insurance, not a premium refund, to employees who reach certain wellness goals, would the difference in the premium be considered taxable?
I believe there's a limit for that of up to 30%. So premium reductions or premium discounts up to a certain amount are not taxable.
Okay. Very good. As we're getting questions, I want to remind everyone to please submit all your questions to the question and answer feature as opposed to through chat. That we will likely miss questions if you submit them through chat. If you, let's see, answered this one already. How do you determine the taxable amount of donated time for taxation purposes?
So with that, it would be, if it's 1-to-1, it would be I believe it's, and maybe Tim or Wes, I might need help with this one. I believe it's the value of it to the employee that's donating it. Can't quite remember. Is it the rate of the donor or the donee? I think it's the donor, right?
It's a great question. I don't know if I know the answer. Wes, do you have an input on that one?
Not off the top of my head, but I'm going back through my notes to try to provide that one at the end.
So we'll come back to that one.
Yep.
Great question. Stumped us.
Yeah, it is bound to happen. You recommend recording PITA payments be recorded on W-2, perhaps in box 14.
You want to take that one, Tim? Is there
Because of the
the
W-2.
W-2 recording?
Yeah, I don't believe they would go. So box 14, is one of those fun ones. And it's pretty much whatever you want. I mean, there's some guidelines and some common items that go in there. We'll be talking about that in the next segment. But I would say there's nothing preventing you, but I don't believe there's a requirement to record PITA payments there.
Typically, in my experience, we haven't recorded them anywhere. It's just that they are, since they're not subject to tax, they're not included in box 1 or your Social Security wages, Medicare wages. Well, PITA, they wouldn't be subject to Social Security, but they're not in those Medicare or box 1 wages.
Yep. Just to confirm that tuition reimbursed to an employee that exceeds the non-taxable amount per IRS rules is subject to federal and state income tax as well as FICA and Medicare.
Correct, because it would be taxed as any other income over the $5,250.
Okay. We do have a question. It just says, how about tuition reimbursement? I assume it's a generic question on whether or not that is taxable.
Tuition reimbursement up to the limit of $5,250 is not taxable. Anything reimbursed over that limit would be taxable.
Excellent. Is the value of employee benefit to be used toward recreation and fitness programs taxable, even if it is never used in place of patron registration? So in essence, no foregone revenue.
I believe, I'm not sure about that, but I think that if they do have the ability to, if they could book that prime time where even if they don't, it would be taxable because they have that option. There's nothing stopping them, so that benefit is available to them.
All right, thank you for that one. Great question here. I think it would benefit to define business miles. What will constitute a qualified mile for business purposes?
So business miles would be miles driven to meetings or anything related to your job and carrying out your job. If it's not related to carrying out your job, going to a meeting, going somewhere, for your job, then that would be personal use.
Yeah, I know we've gotten great questions on this topic in the past. What about a situation where, you have your commute to a job, but you make a detour to the grocery store on your way back? Would that detour then have to be excluded from, the standard mileage between 2 points? If it's a personal trip to the grocery store.
I think you're getting in the nitty gritty. I mean, so I think that, if it's on the way, then perhaps, if it's not there, but they should make a practice of doing that. You should not, that doesn't really seem honest to make sure that, oh, I'll stop at the Jewel on the way to this meeting and now it's covered in my business miles. I don't think that would be very honest.
That's an appropriate answer. I have a comment here. I thought a program discount was taxable above the 20% allowable IRS percentage. That is what we were instructed in the past by Maggie.
Program discount was taxable above the 20%. Not sure I understand.
It might be one to follow up on.
Yeah, let's follow up on that one.
Sure thing. There's a date exception for auto allowance. Does that date exception also exist for wellness amounts?
Let me follow back up on that one as well. I don't know about an exemption for the wellness amounts.
Okay. Would reimbursement of tuition fees and books for a course at an accredited university be taxable if the course is related to their job and toward a master's degree in their field?
If it's related to your job, then it would not be taxable. But if it's, let me see, would reimbursement of tuition fees and books for a course, even if it's related to your job, though, there's still the limit of $5,250 per year. Now, if it's not related to your job, it is taxable. There is no, it has to be related to your job to not be taxable up to the limit.
And would that be like a requirement of the job, or simply is being related a good enough standard, or does it need to be a requirement in order to keep a job?
Related, it can just be related. It doesn't have to be a requirement. Now, if it's a requirement, if it is a requirement, then it would not be taxable. If you're required to do this, you're required to maintain training of some sort, that is not taxable. That's different than tuition reimbursement going towards a degree.
Mm-hmm. All right, and I believe that covers a couple of other questions, so we'll clear out some duplicates here, but can you briefly go over discount on programs not being taxable? If we give discount on the programs, they have to pay in full, and it's not allowed to be put on payroll to just pay taxes.
Let me see, let me read that one again. I don't think I understand. It says if we give discounts on programs, they have to pay in full, and it's not allowed to be put on payroll to just pay. I'm not sure I understand that.
Yeah, okay, maybe we can get a clarification on that question. Are education awards taxable? So if an employee completes a certification class and they are given a $500 bonus for it, is that taxable?
Let's see.
It would be yes. It's not a reimbursement. It's a
right. It's a bonus. It's just income.
Yeah.
Sorry, I'm trying to read them, and you're reading, so it's like I'm trying.
Yep. Shouldn't you have a written plan regarding tuition reimbursement for all employees versus offering a tax-free amount to a specific employee?
Yes, it should be part of a plan, but the 5,250 is what the IRS allows, but yes, it should be part of your employee handbook or your policy so that it is written out explaining that policy.
Yeah, I think that's just a good point in general that ventures into HR territory, but when in doubt, any and all things should be written down and consistent across your workforce. You know, I don't think any of us proclaim to be HR experts, but always, you know, documentation is good, fairness is good, and when in doubt, something should be written down as a policy.
Right. And I apologize if I made it seem like it was just standard that any employee could just come to HR and ask for tax-free, you know, reimbursement. No, it has to be a policy where they have an application process and they go through that for it to be reviewed and approved.
Mm-hmm. Another question on tuition reimbursement. Does it have to be for job-related courses or can be for a new career, hobbies, et cetera? In other words, purely personal.
And new career, hobbies, that is taxable.
Right. And the question
job.
be, can an employer reimburse for tuition for any reason? I think the answer to that would be it's entirely up to the employer whether they want to reimburse for it, but for those purposes,
Will be taxable.
will be taxable.
Yep. An employer can generally reimburse for whatever they want to. They just have to determine if it's taxable or not. And if there's nothing excluding it from tax, then it is taxable.
Mm-hmm. What would be the reporting requirements for benefits provided to board members, such as fitness memberships or pool or beach passes?
Those benefits are the board members are not paid, I assume.
Yeah, assuming the board members are not paid, I don't know the answer.
I don't know, and Tim, if you could help me, or Wes, I don't know if it's any different for board members than employees as it relates to those no additional cost items.
That one, I don't know off the top of my head. Wes, any input on that one?
Researching that one for you guys too.
Awesome. That's another follow-up item for us. This is a good question about an incentive for waiving insurance coverage. I do see this come up often, but if you offer an incentive to all employees to waive insurance coverage, the cash payment is taxable, but are there other tax ramifications for those foregoing the benefit? I assume you mean foregoing the insurance coverage and receiving the cash payment. I believe that's the question. I think it's as simple as you would receive the cash payment in lieu of the insurance benefit, and that cash payment is taxable. I'm not sure what other options there would be. I would be surprised if anyone turns down a cash payment.
Right. I think we actually discussed this one. It's like if someone works, they don't, even if they say, I don't want my paycheck, you would still cut them their paycheck. So you would still pay them that. We don't know. And please provide more details if there's a situation where they say, well, I don't want the opt out and, you know, I don't want the cash for not having insurance. I would think you would handle it just like if someone said, or you cut them a check and they never cash their paycheck, it's still theirs. So they're still entitled to it based on the policy.
Right. Touching again on the vehicle topic, isn't the commute between home and work considered personal miles?
Between home and work in your personal vehicle is personal miles. However, if the employer is providing a vehicle, this is where it's an employer provided vehicle for commuting.
Awesome. Thank you. Are reimbursements for items such as CDL licenses or other licenses and certifications for the job taxable? I'll assume those are requirements of the job. In other words, if you're required to have a CDL or
certification, like an arborist or water certification, those
Sure.
would not be taxable as is required by the job.
Great.
And a lot of times those are also included if you have a union contract, they're included either in that contract or a policy stating that it will be reimbursed because it's a requirement of the job.
Great. I think we have time for just a couple more questions. Obviously, if we have time toward the end of the session, we may come back to a few questions if we don't have time to get to them now. But let's see, a program discount that is taxable, for example, preschool, we give a 50% discount. We tax 30% of the discount because we were instructed that the IRS allows a 20% non-taxable discount for employees, and any discount above 20% is taxable.
So I think that's similar to the question earlier. And so we will get back to you with that exact percentage, because I believe you're correct in that the discount is only non-taxable up to a certain amount. We'll follow up to clarify what that amount is.
Yep, I've saved the clarification there in the follow-up list. So we'll do just two more here on tuition reimbursement. What is the $5,250 limit on? I take a class in the third quarter, but I send in payment reimbursement in January when I get the results. Does that go in year one or year two?
I believe it's cash basis
timing
is when
thing.
you receive it, right? You can't receive more than $5,250 in reimbursements in a calendar year.
Yeah, I think a good fallback is typically the IRS handles things purely on a cash basis, at least in the personal tax world.
Yep.
Finally, is PETA time pensionable?
Yes.
Great. All right. I'll leave the questions up. I think we'll take this opportunity to move forward into the next section. But I'll leave the questions up in case, like I said, we have time to get back to them. But we have plenty more content to get through. So we'll move on to make sure we have time for everything.
And I'll try to answer them within the chat or within the Q&A as you go through things, Tim.
Awesome. And my turn to share the screen. Okay, yeah, hopefully see the title slide, payroll forms, important deadlines and reconciliations. I'm going to take this section and to go over here the two common forms that are issued at year end to people who have received money, and typically someone you've paid money to is either going to receive a W-2 or a 1099 with some exceptions. But we'll go over W-2s first, and I'll talk about the kind of the basics of what a W-2 is, some of the nuances and ways you can improve your W-2 prep process. And then I'll kind of do the same thing for 1099s, as that's been a topic with some evolutions in the last couple of years. So hopefully we'll get some good questions answered there. But starting with W-2s, essentially, if you've paid an employee any wages during the calendar year, they're going to receive a W-2. Obviously, the big distinction there is employee earning wages versus a vendor receiving payment for services. And
Tim, can I interrupt you for a second?
oh, absolutely.
I can't see your screen share.
Okay, well, I appreciate the heads up there. Let's try to fix the. How about now?
There we go. All good.
Okay, I'm so sorry about that, everyone. Thanks for the heads up. I saw chats coming in and finally caught my attention. Well, you didn't miss anything important. This is the first slide with actual writing on it, so we'll pretend like it didn't happen. So, like I said, the important distinction to make is to be very clear about who's an employee and who is a vendor. IRS is very clear on how important that is. And I get questions every year on, I'm paying someone for this. Are they considered an employee or a contractor? The bottom line is the threshold for calling someone a contractor is pretty high. So when there's a gray area, it's safest to assume that you've paid someone wages. Obviously, there's a lot of room for discussion there. So I imagine we'll get some questions on that. But that's kind of the main thing to fall back on. So the purpose of a W-2 is to report each category of taxable wages. Obviously, every employee is subject in Illinois is subject to 4 different taxes: federal income, state income, FICA Social Security, and FICA Medicare. So essentially, the W-2 says these are your taxable wages in each of those categories. And then these are the taxes that have been withheld for those categories. Obviously, it would include state and local taxes as applicable. In Illinois, we have state. And then, of course, those additional information boxes. And that's typically where I spend a bit of the time here on describing what those boxes are and what their purpose is, because there's tends to be a lot of confusion on what goes in there. But my advice to all of you, when faced with the prospect of preparing W-2s for your employees, is make sure that your payroll system is set up correctly. That's the first kind of advice on prep, is doing the work ahead of time to make sure that your payroll system has all the right boxes checked and things configured is going to make the W-2 process infinitely easier. So for example, I've got pardon me. This is just a kind of a generic payroll system. Yours will likely look very different, but this is a kind of a sample setup for a 457 plan deduction. So it's one thing to set up the numbers to say, yep, we have a 457 deduction available to assign to an employee, and it's calculated either as a percentage of pay or a flat amount. But the most important thing for tax compliance and for W-2 prep is some of those other areas. So you have, in the middle here, this particular payroll system allows assigning it a special type so that the system can handle some things automatically. Your system may allow for that, or you may have to set something manually, such as an annual limit. So 457 plan has IRS sets limits on how much you can contribute. Your system should be configured to track that and make sure. And we'll be talking more about limits a little bit later on. But if your payroll system is configured correctly, you can avoid those troubles at year end. And then specific to W-2s, your system will hopefully allow correct coding so that a 457 plan can, for example, be assigned a box 12 code so that when you generate those W-2s, all of the contributions that have been made to this deferred comp program show up correctly in the W-2. So you're not having to manually intervene and put those amounts on there. So that's just a little bit of advice. Now the actual W-2 looks like this. I would be surprised if there's anyone in this webinar that has not ever received a W-2. The format has not really changed in quite some time. But the section that is kind of most commonly understood is the wage types and their related taxes. But it's the extra boxes that are a little bit more less understood. So that's what I'm going to cover, is those other boxes. So referring back to that screen, the kind of box 10 through 14 or 15 are the confusing ones. Box 10 is used for dependent care. So any benefits provided under dependent care assistance program. Box 11, excuse me, amounts distributed from a taxable deferred compensation plan. That one's probably not as common. I'm noticing that I did not update this slide from a presentation I did in Wisconsin, so I apologize. Box 13 is a few boxes to either mark someone as a statutory employee, mark that they're part of a retirement plan, or that they've received third-party sick pay. For retirement plan, that should say IMRF. And then for boxes 16 and 17, state wages and income tax withholding, that should say Illinois 941. I will update the slide before we share them following the webinar. But jumping back to box 13, statutory employee is rare, at least in my experience. The idea is you have a contractor, but you are paying them as an employee specifically for tax purposes. If you find that box being checked for anyone, be cautious that that's being treated correctly. Again, it's not terribly common, at least in my experience. If any of you have statutory employees, it'd be interested to hear your experience. Retirement plan is far more common, and again, IMRF is a great example there. Third-party sick pay, a less common one. That is when you have an insurance provider making sick pay payments. You are still responsible for paying the employer payroll tax on that, but someone else is handling the payments, so there's an identifier there on the W-2. So since I didn't go in order, there's two boxes that require a little bit more description. That's boxes 12 and 14. So I'm going to go over box 12. And this is extra fun because they have 29 different codes. Luckily, we don't really need to care about most of them. So I've got a table that's going to explain the common ones that we care about. But the point of box 12 is to help determine the amounts that affect the taxable income. So effectively, they're for reference, but they give some information on how the taxable income has been arrived at. Some are optional, but recommended. So in other words, if you want to be as compliant as possible, if it's recommended, I say go ahead and do it. Are there penalties for not disclosing something that's optional? No, but I think a lot of us are accountants and tend to err on the side of compliance, so we encourage that. But here's some of those common box 12 codes. Excuse me. We have code C would be the taxable cost of group life insurance over 50,000. This is one of those information only, but it is helpful. And for those of you who are not familiar or don't offer this benefit, group life insurance offered to employees is not taxable to the employee up to a benefit amount of 50,000. But if you offer an employee or if they elect, additional coverage, say, $100,000, there's a formula, a table with amounts that need to be added to taxable wages. Based on the amount of the benefit and the age of the employee. And that's what ends up in box C. But also, if you're not doing this for your group life insurance beyond a $50,000 benefit, you do need to be doing that on an ongoing basis through payroll. That is a taxable benefit, kind of jumping back to the previous section there. Code E would be any elective deferrals under a 403B plan. So that would apply to any of you nonprofits. Code G, as I showed in that earlier screenshot, elected deferral under 457 plan. Item J, non-taxable sick pay, that is an information only, so effectively optional. Code W is employer contributions to an HSA plan. Code BB is Roth contribution to a 403B. This is obviously related to item E. Jumping ahead to EE, Roth contributions under 457. That's obviously related to G. Make sure that you have that differentiation there to kind of recap most the regular 403B or 457 plans are pre-tax. Roth is post-tax. Finally, DD, I do get questions on this fairly often. DD is supposed to report the cost of employer-sponsored health coverage. That one, the questions I tend to get is, what are we supposed to include? And yeah, you should be including the total premium for the health coverage. That would include not only the employer portion, but as well as the employee portion that's being deducted. It doesn't mean you won't be able to calculate. It's not a reconciling item for the taxable wages. It's purely required by the Affordable Care Act. So the other question I get is, well, what about other stuff like dental coverage that's separate from the main health coverage? That is actually optional. So you can just say, this is our primary health plan. These are the gross costs of the premiums. Or you can lump in the dental plan into that as well. Moving on to box 14. This is, I call this kind of the Wild West box. There's really not a standard list of items. It's just sort of other information. So some common things that are disclosed in box 14, any charitable contributions made through payroll deduction. That's helpful to the employee if they are itemizing deductions and they're getting a charitable contribution deduction on their taxes. If they have something automatically taken out of their paycheck to be diverted to a charity, it's helpful to include that on the W-2. Educational assistance payments, health insurance premiums deducted, that can serve as a reconciling item from gross wages to non-taxable. Any non-taxable income the employees received, state disability insurance taxes withheld, uniform payments, union dues, and honestly, whatever else you want to include in there. There really isn't a standard list. So moving on into the practical things of preparing and make sure you're doing things correctly. Step one, before you do your W-2s, make sure your 941s are done and then reconciled to your W-2 register, or starting with your W-3, which is the summary of all of your W-2s. So those several boxes in the 941s will correspond to the W-3: total federal taxable wages, total FICA Medicare, total FICA Social Security wages, and then their related taxes. Those should all correspond to the totals of your W-2s. They do need to match. So if there are any differences, they should be investigated and resolved before the W-2s are issued. And another tip, I feel like it shouldn't have to be said, but make sure you are issuing W-2s for every employee you pay during the year, even if they only got one paycheck at the beginning of January and then they quit. If you paid anyone wages, they need a W-2. And you would discover that if you are reconciling your quarterly 941s to your W-3. As an illustration, this is probably due for a year update, but the fundamentals are the same. This is an example of a completed reconciliation of quarterly 941s to your W-2 register. So the idea is you're taking from each quarter the total federally taxable wages, the total FICA wages and Medicare, total Illinois wages, and in this case, if you have other states, we have some border states for, near Wisconsin that are required to withhold Wisconsin taxes, so include those as well. And then the totals of each quarter should be compared then to the totals from your W-2 register or your W-3 summary. And any differences should then be investigated. And then the corresponding tax amount. So what should correspond with the federally taxable wages should be the federal tax withholdings. So same thing, whatever you reported on each quarter's 941 should be compared to your W-3 or W-2 register totals, and any differences should be investigated. Now you'll see here, the W-2 register is going to show what was withheld from the employee, whereas your 941 is going to show the total employee plus employer FICA taxes. So your difference should come out to as close to half of that as possible. So that's a difference that you should expect to see, except maybe in the case of FFCRA wages, depending on how that all came together for you. So again, just an illustration, your form may look different, but I highly encourage putting together a form like this and keeping it current throughout the year. Every quarter you do your 941s, perform this reconciliation so that you're caught up every quarter and you only have one quarter to investigate at a time. Another helpful tool is, this is advice that I got a few years ago. When you're doing W-2s, take a single reconciliation form like this, take one of the W-2s and recalculate everything. And the recommendation would be take the highest level employee in the organization. So, city manager or executive director, take their W-2 and just recalculate and affirm the amounts. Excuse me. So recalculate their IMRF wages. IMRF wages should be, their gross pay minus things that are not applicable to IMRF in most cases, and reconcile that down to what their IMRF wages should be. Federally taxable wages, take their gross pay, back out the items, the pre-tax deductions, Section 125s, 457s, the IMRFs, and that should reconcile to their federal taxable wages on their W-2. And Medicare, similar, but obviously the deductions are a little different. You lose out on some of the other pre-income tax deductions, and that should reconcile to their Medicare wages. So this does a few things. You can provide this reconciliation to the top dog, and they know that you're doing things correctly, that you're doing some detail work to make sure that things are coming through correctly, but also they're likely to be the ones with possibly the most deduction items or the most stuff going on, and you may discover a problem that will permeate through the rest of the employees. So this is a great place to start, and if you discover a problem, chances are you have others to fix. So I would start with the highest level employee, and then if you discover a problem or if you want to be extra assured, do a sampling, pick up a couple of department heads or other random employees or even some part-timers and do the same exercise. It doesn't have to take very long, but it provides an extra level of assurance that just is a good comfort. And in terms of due dates, the W-2s are due January 31st. This date fluctuates a little bit each year depending on where the 31st falls. If it's on a weekend, you get to do it the beginning of February, but this year W-2s are due the 31st to the employees, as well as filing with the federal government and state of Illinois. Again, neglected to update this slide as well. So pretend that says state of Illinois. Also, I stressed this already, but it's worthy of being said again. Make sure all of the W-2s match the totals of your 4 quarters of 941 returns. So I don't mind repeating myself on that point. So I'll move on to 1099s. We'll take Q&A on both topics at the end of my section. But actually, I do believe this is a good opportunity. We're about halfway through our time for the day. So I'm going to pause here and we're going to take a 10-minute break. So get up, stretch your legs. I know webinars can be a little bit more tiring than being in person, but I'll go ahead and pause for now, and we'll reconvene at about 10:20. But I'm going to move on to 1099s, and the same idea. We're going to kind of go over the basics of what each common 1099 form is, and some of the pointers on what the requirements are, as well as some preparation pointers. So 1099s is the fun topic, and it's the kind of the counterpoint to W-2s, in that your W-2s are reporting payments to your employees, 1099s are reporting payments to non-employees. And believe it or not, there are 21 different varieties of 1099s. Luckily, we only need to really care about 3 of them. The 1099 NEC is for non-employee compensation. That one was new recently and replaces the non-employee compensation formerly reported on the 1099 MISC, which is still one we care about. Finally, the 1099G is basically government payments. I'll talk about that one a little bit more. Not as common, but still one you need to know about. 1099s do go to individuals and partnerships, and then all attorneys, and are not sent to corporations. So I'll mention the easy way to make sure you're sending to the correct recipients. It is extremely rare that you would send a 1099 to an employee. Believe it or not, I've seen it. And the example I've given, and even my example is open to critique, but you have an employee who performs a defined function. Let's just say they're a police officer, and on the side, they have a small business as a sole proprietor that does a completely different service, and through legitimate means in a way that is totally compliant with IRS regulations on what constitutes a contractor, they perform a service through that business that is totally unrelated to their employment. Again, even then, I think you have to be really, really careful. The work that would have to be of a true contract nature and not at all related to the work that they do as an employee. However, if you find this situation coming up, and I get this with school districts where you have a teacher who also does, might referee a sporting event. In a lot of cases, it's most safe to assume you are paying them taxable wages for everything you're paying them for, and go from there. Essentially, the rule of thumb is, just going back to the beginning, if you have to assume it's taxable unless you can prove that it's not. Same thing with a contractor versus employee. You have to be able to prove that they're a contractor, otherwise they're an employee. Another basic about 1099s is there's a $600 minimum. If you have a contractor who you paid less than $600, don't send them a form. There's no penalty for sending them a form, but it's annoying and it's more work for you. So I advise against it. All right, well, starting with the 1099 NEC, again, the NEC stands for non-employee compensation. So that is no longer reported on the 1099 MISC. And that started last year. So what is reported on this form? Essentially compensation for services provided by contractors. So that's going to be a lot of the 1099s now. You'll have more NECs than miscellaneous, most likely. So who receives the 1099 NEC? That'd be non-employee contractors, so individuals, partnerships, and estates. Attorneys, except for gross proceeds, that gross proceeds amount typically relates to settlements from lawsuits, but the fees that you're paying, even if the attorney is formed as a corporation, any legal fees you're paying would be issued on one of these. And again, the $600 threshold applies, and the due date is the same as the W-2 due date. So January 31st must be filed with the recipient as well as the IRS. So the form itself looks like this. It is one of the simpler ones. So the most important and commonly used box there is box 1, and that's the amount of non-employee compensation. Excuse me. If you happen to withhold any taxes, you've got boxes 4 and 5 for that. But besides that, you're likely only going to be filling in box 1. So as a result, it becomes one of the more simple forms to prepare. But that's that. And the 1099 MISC has been a more familiar form for a number of years. Most important point now, and I've said it a couple of times, but I'll say it again, it's no longer for non-employee compensation. So what is reported now? The most common items are going to be rents paid to a landlord, prizes and awards, other income payments, gross proceeds paid to an attorney, again, that is not attorney fees, non-qualified deferred compensation, and again, $600 threshold still applies, and the due date for the 1099 MISC, January 31st to the recipient, March 31st to the IRS if you're filing electronically. If you're sending by paper, February 28th. I don't recall if they're still allowing filing by paper. It's safest to assume to always file electronically. I highly recommend it. But this is the form of 1099 miscellaneous. Again, should be fairly familiar. There's a lot of boxes that most of you aren't going to care about, such as fishing boat proceeds or crop insurance proceeds or fish purchased for resale. Please, if you have a story to share about using box 11, I would love to hear it. The most common boxes there are going to be box 1 for rents, box 3 for other income. Any income tax you may have withheld goes in box 4. And that's going to be most of them. I don't think too many of you are offering excess golden parachute payments. Again, if you have a story to share, I'd love to hear it. And then the last 1099 that we care about is 1099G. And this, in practice, most commonly used to report unemployment compensation. So someone who received unemployment is going to receive this from who's paying out the unemployment. Most local governments, this form is useful for reporting taxable grants greater than $600. So if you've issued grants to recipients for whom those grants would be taxable, they need to be issued a 1099-G. I don't see this very often in practice. And it may be just it's less common to issue taxable grants, but it is something that I encourage all of you to be aware of. Again, if you're issuing a grant to a private organization, it's safest to assume it's taxable and to issue the 1099 than to assume it's not. It's the recipient's obligation to file their taxes correctly, and if it doesn't happen to be taxable, no harm, no foul. But if you are in a position to issue one, you're doing your duty to issue that. Again, same due dates as the 1099 miscellaneous, January 31st for the recipient, March 31st filing electronically. And this is what the 1099-G looks like. Similar to the 1099 miscellaneous, most of you're not going to be filling in this unemployment compensation. You're going to care about box 6. That's the taxable grants box. And again, most of the other boxes are likely to be ignored. Agriculture payments, market gain, not something that you need to worry about. So some tips on preparation. First step is always information gathering. What are you going to need in order to correctly prepare your 1099s? You need basic payee info. If one common thing you would have seen in all the forms is the recipient info, the legal name, their address, their FEIN or social security number, and you also need to know the type of organization they are. I mentioned earlier, you're not sending 1099s to corporations. That's why the type of organization is important. So the tool that provides you all that information is the W-9. If you're not already collecting W-9s for every single vendor you set up in your system, you need to establish that practice now. Number one, it makes sure that if you're able to set the settings correctly in your accounts payable system, you're way ahead of the game, but also reduces the strain on trying to get those at year end when you're preparing the 1099s and you're under a time crunch. And of course, you would need to know the summary of amounts paid to those vendors for the calendar year. Again, great bullet point there on the bottom. If just like I mentioned with the payroll and feeding W-2s correctly, your system, if it, most accounting systems have in their accounts payable function 1099 settings for vendors. Use them. They'll save you a lot of time on the back end when it comes time to prepare them. So the preparation process, and this is generic, obviously your systems may differ, they may do some shortcuts for you, but the first thing you'd want to do is run a summary of vendor payments. If your system allows you to exclude non-1099 vendors, I would say do that. That saves you some time, but at least lets you get an overview of these are all the payments we made in total for each vendor. Next step would be to eliminate corporations and employees. Again, if you're paying employees as a vendor, chances are, hopefully, it's because it's a non-taxable cost reimbursement that wouldn't go on a 1099 or a W-2 anyway. Then you get to eliminate anyone under $600, so that by that point, you need to prepare either a 1099 NEC or miscellaneous for everyone who's left over. Once the forms are prepared, then you need to file with the IRS and send the recipient their copy. If you are filing paper forms, you do need to submit Form 1096, and that's a summary. So just like the W-3 is a summary of the W-2s you're issuing, 1096 is a summary of the 1099s that you're issuing. So with that, I'm going to open up the Q&A and invite my other panelists who can help me answer some of these questions. I see a lot have come in and are coming in. So we're going to do our best to get these answered. And I'm going to stop sharing briefly so we can share our faces. So I'll read out the questions, and if I can answer it, I will, and I'll invite the other panelists to join in if need be. First question I see: employer paid 457 contributions through accounts payable. Do these go into W-2? Do they get reported as gross wages and then removed from taxable wages? What goes in box 12? I guess my first question would be why you're making 457 contributions through accounts payable. I would always recommend those go through payroll. They should end up on the W-2. And I actually don't see employer paid 457 contributions very often. I'll be honest. I don't think I work with anyone right now that makes those. Wes, those should be included in gross wages?
Not in gross wages on the W-2, no, but they should be reported in box 12 in conjunction with the employee contribution.
Excellent. Is box 12DD required? And what if it's incorrect? So box 12DD, I mentioned earlier that that's an ACA requirement. Now, it's safest for me to say it that way, but really, if you're a smaller employer, I think the threshold is 250 employees. It's not a requirement. Again, there's no penalty for complying with something, but it's not a requirement. No one is reviewing the information. They're not, if you don't include everything the guidance says you should include, there's not really a penalty for that. So if it's incorrect, there's not really, I would encourage you to make it correct. Not a penalty for it. Box 12, code WHSA, was told both the employee and employer amount goes in this slide. My slide just said employer. I think it's just worded poorly and I can revise it. It's really an employer sponsored HSA plan. So typically you're going to have, an employer contribution and an employee contribution. Those really should both go in there. So before I share the slides, I'll make sure that's more clear on that. It should be employer sponsored plan and all contributions that go in.
Yeah, and maybe just expand on that real quick, Tim. The reason it says employer contribution is that's what the IRS defines as code W for box 12. So I think the IRS does a poor job of trying to communicate what needs to be reported, but it's the total HSA contributions, whether it's employer or employee for that given year.
Awesome. Thanks for that clarification. Does workers' comp amounts get reported on the W-2? And the answer to that is no.
Yeah, I think the answer gets complicated depending on what type of employee we're referencing and what type of work comp wages we're paying out. If it's 100% because it's going public safety, or if maybe it's a streets guy that's receiving the 66 2/3. Might be a bit larger topic outside the scope of the purpose of this training, but we can certainly expand through email after the training.
Yep. Are there any specific changes to W-2 reporting for 2021? Not that I've been made aware of. Are IMREF voluntary contributions included on W-2?
So this is box 14. It's an optional if you want to report it to the employee. More than welcome to, but not required by the IRS or Social Security.
Yep, that's what I was going to say. In addition to uploading W-2 info on My Tax Illinois, does it need to be submitted to the state anywhere else? No. The important thing to note is, though, Illinois does require electronic filing. So you do need to be on My Tax Illinois, and you do need to be submitting those electronically. But those don't need to go anywhere else for the state. Employees who opt out of insurance receive medical insurance opt-out compensation. We offer a 457 plan with both pre and post-tax contributions. Are the medical insurance opt-pay wages subject to the pre and post 457 plan? Let me make sure I'm following the question.
Basically, is it included in gross pay? Well, right?
Yeah.
Because I believe 457 deductions pre and post tax are taken on gross pay. So
Yep.
that would be included in there, right?
Yep. That's my understanding as well. Okay, we have an employee who is leaving later this month and moving to a different state. However, we want her to do some remote work until we fill her position. So is it okay to treat her contractual going forward? Like I said before, the threshold for determining that an employee is a contractor is very high, or a work provider, service provider. If they are, you have to, and you can refer back, I'm mostly reciting this from memory. So the IRS has guides on how to determine whether someone is a contractor or an employee. And it involves things like, actually having a contract, the service provider providing their own tools, their own workspace, working in their own time, and things like that. So if they're performing employee-like services and they don't meet the threshold to be considered a contractor, it's safest to assume they are an employee. In other words, it's going to be, you'll have to prove it. The IRS does pay a lot closer attention to this in the last several years than they ever were before. So without knowing any other factors, I'd say in all likelihood, you still have an employee unless you can prove otherwise. Utility companies do not get a 1099. One of our phone carriers is a partnership. Should this company get a 1099, or are they considered a utility? A phone carrier as a utility, I don't believe so. I think, again, it's safest to assume if they're a partnership and they're providing a service that they are going to get a 1099. I can say I've had organizations I know that literally issue 1099s to everybody, no matter what. An administrative nightmare, and I don't recommend it, but the only penalty to issuing a 1099 to everyone is annoyance and administrative costs. So again, I don't recommend it, but if there's a gray area and you're not sure, go ahead and issue it. And the recipient has the responsibility to file their taxes correctly. And if it doesn't apply to them, it doesn't apply. For 1099 NEC, do we need to upload all payments electronically for 2021 instead of by mail? I assume you mean all forms, because the payments already would have been made, and unless you are, unless you mean tax withholding, but yeah, I would recommend electronic. I don't believe electronic filing is required yet for the IRS, but
No.
I recommend it, but if you have to submit by mail, you can. Recommended electronic filing service for 1099 NECs that is free, I believe, through the, and this is, I might be getting W-2s mixed up with 1099s. I may have to get back on that one rather than try to guess from what I think I remember. That's a great question. Will the American Rescue Plan monies, one of the usage of the monies is that the municipality will be issuing grants to residents to make repairs to home? Would that require a 1099-G? So to clarify, municipalities out there are receiving funds from the federal government under the American Rescue Plan Act. Municipalities have the option to subgrant to either direct to recipients, residents, private organizations. I would say it's safe to assume that if you're granting funds in that manner, that you should issue a 1099-G to all recipients. If grants were issued to employees who were terminated due to COVID, would that information have to be reported on 1099-G? That's a tough one, and I think it depends on how you define the payments that were issued. It could be considered employee compensation under certain circumstances. And without knowing much more, that's a tough question to answer. Wes or Erica, any input on that one?
Yeah, I guess I'm questioning whether it's a grant or some sort of severance or separation agreement.
That's what my thought
And that would
was.
really determine what type of forms we're filing, or if it was still W-2 wages at that point, depending on the timing of the payment.
Yep.
So I think we could probably assist with that one via email after the presentation.
Yep, we'll look into that one a little bit more. That's an excellent question. Sole proprietors with a DBA or doing business as name and an FEIN always want you to use the FEIN and not the social security number on the 1099. Do not want their SSN out there. Still must use social security number. W-9 line 1 must be their name, not the DBA. So I use a social security number. That is a great question. I don't have that one come up very often. If they have a doing business as an FEIN, I don't know that it's wrong to use the FEIN. I say that with a little bit of hesitation. Wes or Erica, do you guys know?
I think you're correct. Typically, if you're a sole proprietor doing business as, you're still functioning and operating as the individual, just doing it in a different name, so it's reported into the Social Security number. But if you go to file a 1099 with the DBA, you'll likely get a notice from the IRS in the springtime saying that there's an issue because the tax ID doesn't match the name. So anytime you do have a vendor that is doing business as a different name, you want to make sure that you're using the individual's name and not the DBA.
Yeah, so the legal name, which would apply to even a company name with a DBA as well. I think I got a duplicate question here, so clear that out. We use box 6 medical payments for pension fund disability exams and paid medical exams for employment, to name a couple. Yes, that's a good point. I guess I sort of glossed over that one a little bit. But medical payments is a valid use for that. And medical payments, again, that is not just like employee provided health insurance, but actual payments to medical providers. And that is, yeah, something to be aware of. So thank you for that input there. Question, an example of auto parts or repair shop that a organization purchases auto parts from at times, have them repair vehicles at times. Should we report all payments to the vendor or just the payments for repairs?
Great question.
Yeah,
I think in my experience, I haven't run across this particular example, but in some cases you may have a vendor or sole proprietor who provides a service, but also purchases some sort of goods or has some sort of travel allowance included in whatever their contract is. Those payments that are for travel or hotel or any handouts or things that are provided by that individual are typically not included in the total on the 1099. So I would assume similar situation in this example, but I'd have to do a little research to be 100% accurate. Yeah,
my experience with this one is if you have a way to separate the two, I know the way most of us pay invoices, you may have an invoice that's got both on there and there's not an easy way to drill down. If you have to include the total amount, include the total amount. If you have an easy way to segregate those two things, you can. That's my experience. How often should W-9s be updated? Also, someone told me this year that W-9s aren't required to be signed. Is that true? W-9s are not like an annual thing. You don't need to request a new one. It's a good idea if they're getting stale and you still have an ongoing relationship with a vendor, or if you paid a vendor 5 years ago and are now paying them again, it may be a good idea to get a new one just in case something changed with them. You could have had a sole proprietor that turned into a corporation in that time span. You'd want to make sure you have that updated info. If you have an ongoing relationship, you may not have a need to update them. Certainly not every year. The W-9s are, they're given to you by the vendor and then they don't go anywhere. So if you want to require that they be signed, go for it. But there's no, to my knowledge, no regulatory insistence that they be signed. $1099 NEC do not need to be issued to auditors, but to attorneys. They would need to be issued to auditors if the auditors are formed as a partnership, and most audit firms are indeed partnerships. So yes, you would need to issue. If they're a corporation, which in my experience is very rare, you would not need to issue that. But in most cases, yes. Are corporations excluded from 1099G as well? That's a good point. And no, they're not excluded. If you have a taxable grant, regardless of the recipient, they should receive a 1099-G. And this isn't a question, but a very enthusiastic thanks. So I will say you're welcome. Let's see. Okay. I got some clarification on an earlier question. We have the 457 was withheld in payroll, but could be paid to the provider through AP. Yeah, the AP side of that should have no bearing. It's the payroll side of that that would affect the, so it's if it's an employee payroll deduction that you are then turning around and remitting to the 457 plan. Number one, that would just be considered an employee contribution, not employer. But the AP side of that has no bearing on the W-2. All right, and Wes, stop me when you need me to move on to your section, but we'll try to get to a few more questions here before we transition over. We still good on time?
Yeah, plenty of time.
Okay, excellent. All right, if a W-9 vendor checks the box for an LLC, tax classification C Corp or S Corp, is that considered a corporation and not reported? It's that tax classification that's the determining factor. So if they're an LLC and they're taxed as an S Corp, they need to receive a 1099. If they're taxed as a C Corp, they would not receive a 1099, and that's why that selection is there. So if it's not checked, follow up with the vendor and make sure they correctly identify it on the form. When an employee terminates, we make an RHS contribution via accounts payable. Should that be going through payroll? RHS. I'm having a
Retirement health savings.
Retirement health savings. Thank you. Via accounts payable, and so it's on their
Yeah, is it being withheld? So is it like when you convert, if it's like when you convert sick wages to remitted to RHS, I would think that it's similar to the 457, where if you pay it to the RHS plan through AP, that doesn't affect anything if it was withheld from the employee.
Yeah, I believe so. I think there might be something there. I'm going to add it to our follow-up list. Another question on whether 1099-Gs should be sent to corporations. So I answered that already, but yes, they should go to corporations if they receive taxable grants. 1099 NEC or miscellaneous filing. A company is an individual single member LLC that received payments under a developer agreement, reportable income, if so, which form? Again, going back to the other question, it depends on how they've identified their taxability. If they are taxed as a corporation, then no 1099 NEC. If they are taxed as an S Corp, then they get a 1099 NEC. Vendor gets paid $1,200 total, $1,000 is income and $200 for expense reimbursement. They want 1099 to be $1,000, but I send it for $1,200 and tell them to deduct it $200. If I deduct it, they deduct, they will net $800, so I cannot deduct it to prevent that. I mean, you can, my understanding is you could issue it for the $1,000. Again, it's the recipient's responsibility to prepare their taxes correctly. So the onus is on them. If you know you are reporting to them what constitutes a 1099 reportable amount, you've done your job. So if that $1,000 is valid and the $200 is correctly excluded, you can issue to the $200 and then the responsibility has been shifted. Again, I don't think there's a penalty. There's no penalty on your end for sending the whole $1,200. It's the taxpayer's responsibility to get the returns done correctly. We will. Got a question about just what else are we going to provide in addition to the slides. We will have a follow-up document answering some of the follow-up Q&As. We won't be providing every answer every question we've answered live because we haven't been writing them all down. Are 1099s still able to be filed by paper? What if our organization does not have an IRS TCC code yet? Yeah, so you can still file by paper for now. That may change. Just to clarify, yes, payments for opting out of health insurance are considered taxable income, even though it's part of your Section 125 plan. Excuse me. 1099, it should be issued to an LLC functioning as a partnership or individual. That is correct. Again, if they're taxed as an individual and not as a corporation, but definitely to a partnership. 1099 to an estate for an employee that passed away. I believe, Wes, you'll be covering a little bit of that in your section, so I'll defer to that. Any follow-up questions, feel free to ask during that Q&A. I'll keep the, well, yeah. If your question isn't answered in that section, feel free to ask more. Clarified differentiation between S Corp and C Corp for 1099 reporting. So I am not a tax person, but I know enough to be dangerous. So an S Corp is effectively the income for an S Corp flows through to the owner's personal returns. So effectively they are taxed as individuals. C Corp pays taxes as a corporation. So that income for the company does not flow through as taxable income to the owners. And that's the differentiation. Also the extent of my knowledge on that topic, but my understanding is that's why they include those checkboxes on the W-9 so that you can differentiate who's getting the 1099 and who's not. So yes, my understanding is an S Corp would receive a 1099. And to be certain, I'll add that to our follow-up list. If we can provide some IRS references or any corrections to my understanding, we'll certainly follow up. What do you need to do to file electronically? I think it depends on your system. There is a way to do it. The IRS has a process. I've never done it directly myself. The systems I've worked with have kind of facilitated that. So I can't speak to the process. I don't know if Wes or Erica have some insights on that one. I assume you're referring to 1099s. The W-2s is through both My Tax Illinois and the Social Security Administration, and they have, again, their own processes through their websites. So again, I don't know, Wes or Erica, if you have any experience directly filing 1099s electronically.
Yeah, you need to be registered with the IRS to do so, but your software also needs to be able to generate the appropriate files to upload. We can circulate instructions on the process to register, but if you're looking to try to e-file by January 31st of 22, I don't know that there's enough time to go through the process to get set up time for that deadline.
You. So yeah, we've gotten a number of questions on that S Corp versus C Corp issue. So we'll look into that one a little bit further and provide some follow-up clarification. Finally, the last question I've got on the list here, if you are unable to obtain a copy of a W-9 from a vendor, how should this be handled? Well, you won't have the information that would be required to issue the 1099. I would question why you may work with a vendor who can't provide you a W-9. But Wes or Erica, any insights on best course?
Well, my thought, and I mean, I guess this is after the fact, but a best practice would be to require the 1099, the W-9 before you issue payment to a vendor so that you're not in that situation where you have issued payment and now don't have a W-9 in order to issue a 1099.
Mm-hmm.
But
Yeah, and maybe
otherwise,
just to
keep
expand on
following up.
that.
Sometimes,
Sorry, Erica, go ahead.
sometimes vendors do have their FEIN listed on their website. Not all the time, but sometimes, so that you would have that information, but just keep following up. And maybe going forward, make sure you obtain it before issuing payment.
Yeah, and to expand on that, and I don't know if Tim said it during his part of the presentation, but when in doubt, send it out. There is no penalty for sending a 1099 to someone who is not required to receive one, or in this case, if you have the vendor's name, address, payment information, everything but social security number, EIN, they'll complete whichever 1099 form it is and file it with the IRS, distribute a copy to that individual. In that case, the IRS is going to send you a notice and require you to start backup withholding on any future payments to that vendor. But if you're not following the process as Erica recommended in collecting that W-9 prior to that first payment, there are some vendors that don't want to cooperate because they know what cooperation leads to, and it's always best practice to get that in advance of the payment.
Yep. Absolutely. All right, well, the questions have dried up and we've got about a half hour left. So I think we'll have plenty of time for the next section, as well as some follow-up Q&A for any questions that we missed earlier. So I'm going to reload the slides and pass the baton over to Wes to finish this up.
Great, thanks, Tim. Tim and Erica told me best for last, so you should have high expectations for this last section of the presentation. But I'm going to be going through some other payroll-related topics, items that don't necessarily fall into fringe benefits or 1099s and W-2s, although there will be a component when we get into the COVID discussion and how our 2021 returns were affected. But to kick things off, one of the things that I like to review, go through, is the limit changes for actually the current payroll year, so 2022. If my slides are working here. Here we go. I bring this one up first because we're at the beginning of the year. We've probably just run our first payroll of the year and or are getting ready to. It's important to know that a lot of things change from year to year, and limits on contributions to retirement plans, health savings accounts, FSAs, even pensions, all have different limits or caps. So we wanted to illustrate, give a quick reference list of those changes from 2021 to 2022. Especially want to pay attention to the IMRF Tier 2 wage cap and the police and fire pension Tier 2 wage caps. Those things were implemented in January 2011. There's a lot of employers up until this point that haven't had an employee reach those caps. But as they do, we want to make sure that we turn off or set the caps within the payroll system to automatically stop those contributions. Another one on this list that not everyone's familiar with is the pre-retirement catch-up limits for the 457. This essentially allows an employee to double the annual contribution limit for 3 years prior to retirement. And the purpose of that is to allow them to catch up for prior years in which they did not contribute the maximum. Most payroll systems are not set up to accommodate that additional contribution in that 3 years prior to retirement. So you may have to add an additional deduction item within your system to be able to capture that. Won't go through all of them on the list, but wanted to provide everybody a quick reference point for what those limits are for 2022. The next couple of slides are questions that we got multiple times throughout the year in 2021. So we wanted to make sure that we spent a little time talking through what the rules are and what the calculations are on some of these unique pay items. One of those being military pay. And there are a couple of different rules for how these things are paid out on the differential pay side of things. We have employees who may be called to service, so an involuntary active service, or elect to sign up for some deployment or a voluntary active service situation. But in either case, differential pay is the difference between the employee's daily rate of military pay and the daily rate of their compensation through you as the employer. The difference, usually there's a difference there with military pay being less than what they would receive from you as the employer. That difference is what's made up or paid out to the employee. In the voluntary active service, they're eligible for up to 60 work days per calendar year for that differential pay. In an involuntary active service, they are eligible to receive the additional compensation for the time that they are out. There's no limit or cap to that. If the active duty is more than 30 days, the differential pay is subject to income tax withholdings, but not FICA. In our case, federal unemployment tax is not applicable. Issue with the like I'm missing a slide. Apologize. There we go. Unfortunately, another thing that came up several times this year is processing payroll for deceased employees. When these things occur, the focus generally is not how do I get taxability correctly, but finalizing that last payroll. But it's important to take a step back and have an understanding of what the requirements are when an employee passes away and the employer still owes compensation, maybe a benefit payout time. If the final wages are to be paid in the same calendar year as the individual passing away, they are not subject to federal income tax, but are subject to FICA. At the end of the year, these wages would not be included in box 1 of the W-2, and instead would be included on a 1099 miscellaneous box 3 to the beneficiary or the estate. And I didn't read through that first bullet point, but it's probably the most important part of this process is these final payments are not issued to the employee, they're issued to the beneficiary or the estate of the employee. And I believe we did have a question come through regarding W-9. When you request the W-9 of the beneficiary or the estate, what do we do if they don't provide that information? It's the same scenario. You're still going to issue the 1099 miscellaneous. The IRS will contact you regarding backup withholding, but there will no longer be any future disbursements, so the backup withholding would not apply, but you still want to file these returns even if all of the information is not obtained. You do need to make an effort to get that tax ID number, but if it's not supplied, we still want to proceed with filing. In the case of final wages being paid in the year following the death of the employee, so maybe here in the beginning of 2022, we're not going to include those wages on the W-2. They're not subject to federal income tax or FICA, and instead all of those earnings are going to be reported on the 1099 miscellaneous box 3. From a state perspective, I did include some information that's specific here to Illinois. I didn't I didn't throw in Wisconsin to throw you off. But regardless in which year wages are paid, they're still subject to Illinois income taxes. The next several slides are all going to be updates on the FFCRA, or Families First Coronavirus Response Act, which was extended a couple of times, most recently through the American Rescue Plan Act, which was in March of 21. But just to refresh everybody, kind of the timeline of events and what things triggered what, can kind of go through 2020 as a refresher, talk about 2021, what things have changed, and then filing opportunities for any credits that you may have missed throughout 2021, and how to complete the 2021 W-2s for any payments that were applicable to this FFCRA Act. So back in March of 2020, FFCRA was signed into law, and that provided mandatory employer paid leave requirements through the end of 2020. The program was great for employees and private employers. Unfortunately, the IRS did not include government entities as part of the credit or reimbursement portion, but we're still required to participate in the program. At the end of the year 2020, FFCRA was extended on a voluntary basis through March 31st of 2021. That voluntary extension was for employers to decide if they wanted to continue. If so, still eligible for credits. Unfortunately, in the government space, there were no credits, but employers could elect to continue to pay those paid sick leave items as originally rolled out in FFCRA. What did not occur was an increase on the limits or the payments to one individual. So those same limits still applied through March 31st of 2021. Then in March of 21, the American Rescue Plan Act was signed into law, and that extended FFCRA yet again through September 30th. This extension again was voluntary, so not required, but if employers elected to, they could continue to pay those paid sick leave benefits. In addition to the extension through September 30th, they expanded, or the bill increased, the allowable leave. The allowable reasons for receiving these benefits. Previously, it was if you were sick, if you had a family member or someone at home who was sick that you were taking care of, or if you had no daycare school situation, you could qualify for paid FMLA. This expansion through ARPA extended that category from those 3 items to about 9 items, plus extended the length of the paid FMLA, which was previously 10 weeks. It created 12 weeks. In addition to that, everybody's balance reset in March. So if you had previously used 80 hours of paid sick leave for the individual, that balance was reset, so you could have another 80 hours through September 30th. Again, this was a voluntary plan. Credits still applied, but unfortunately, again, not on the government employer side. If you elected to continue to offer FFCRA or ARPA paid sick leave benefits, you were able to recapture the 6.2% of the employer portion of Social Security on those benefits. So if you paid an employee under this program, even though you are a government entity, those payments were not subject to Social Security tax. So each quarter in which those benefits were paid, you were allowed to recapture that portion of the tax. I think we have an example of what that 941 looks like. And you guys will receive a copy of the slide deck after the presentation to go back, but the two boxes highlighted here are where we're calculating what that Social Security credit would be on the CRA wages. Similar to last year, we are required to report to the employee the amount of the paid sick leave that they received under FFCRA. Example here on the screen is showing you where those wages are reported, box 14 other. So this is not information for the Social Security Administration. This is information for the employee when filing their personal returns. But in box 14, if we've paid out sick leave, we should report that to the employee. If not reporting on the W-2 itself, the IRS does give us the option to report separately on a statement to the employee that can be included with the W-2. One of the things that was new for this year and impacted everyone because governments were eligible is the ARPA COBRA assistance. What ARPA, part of the American Rescue Plan Act said that anybody that would be losing their job and be eligible for COBRA benefits would be 100% subsidized by the employer. And the employer in return would receive a dollar for dollar 100% credit on their payroll tax returns for any COBRA premiums paid. There would be no cost to the employee or former employee who is enrolling in COBRA. This is eligible, as I said, for all government entities and any employer in excess of 20 employees. The benefit was only eligible to involuntary termination. So if you had someone that was let go for misconduct or something of that nature, the employee wouldn't be eligible and the employer would not be eligible for the credit for this program. Other opportunities to take advantage of this is employees who were maybe their hours were cut or reduced down below the threshold for requiring benefits. They could sign up for COBRA and the insurance and those premiums would be covered through this program. To capture the credits for the premiums paid, we needed to go through and update our 941, preferably in the quarter that those premiums were paid, but we still do have an opportunity to include those premiums within Q4 if you didn't do so earlier in the year. But lines 11E, 11F, and 13F are what is completed on the 941 to report total COBRA premiums paid, the number of individuals that were provided that premium assistance. And that essentially reduces your tax liability for that quarter on that return. And you'll have essentially a credit which you can apply to a future return or request a check or refund back from the IRS. I don't have an example of the 941, like a picture to review, but it is just those three lines. And again, it's the total premiums paid and the number of individuals that receive this COBRA premium assistance. Questions?
All right. Yeah, we did have a few questions come through. One was in specific reference to the, must have come in before we officially addressed the payroll for a deceased employee. So I think we're good there. Question, if your plan year is not a calendar year, for example, July to June, how do certain limits apply? For example, the FSA limit, is there a plan year limit or a calendar year limit? Same question for HSA limits. My understanding, and Wes, please feel free to clarify, the limits are calendar year no matter what.
Correct.
We have a police officer deploying to Africa next week for most of 2022. We pay his salary 100%. About his wages were exempt from federal and state income taxes as well as FICA and Medicare since it is a deployment over 30 days.
So deployments over 30 days are not subject to FICA, but they are subject to income tax. They, at one point, they were not subject to income tax, but that was changed through the HEROES Act in 2018, I believe.
All right.
And maybe just for clarification, the question says or states that they're paying 100% of salary during that period of time.
Well, they should be paying differential for that period, not 100%. So if you're paying, if you choose to pay, right, I guess if you choose to pay 100%, that I think the differential is what's not subject to FICA. So the differential is subject to federal and state. So 100% would be subject to federal and state.
Last question we have in the queue. Can you do a direct deposit for the final paycheck for a deceased employee? I think there's probably some important clarification there. And I'll give it a start, but Wes, you'll probably finish it up for me. As far as the payment method, if you're making the payment to the correct recipient, the form of payment shouldn't matter. So if the final check is going to the estate and they want to do it as an ACH and you're able to do that, then my understanding is that's not a problem. If you're referring to maybe a payroll already in progress and you maybe started the payroll, employee passes away, and either that direct deposit is in transit or hasn't been issued yet, and it would be going to the deceased employee's account, you would need to stop that payment and reissue it to the estate when that is settled. I believe if the payment has already cleared before the employee passes away, you're good. Wes, you could probably clarify some of that.
No, I think you hit it on the head. If you're in the process of creating a payroll check or you've done your payroll process, the funds have not hit the employee's account and or the check has not been cashed, at that point you're going to want to try to pull those things back and issue to the estate or the beneficiary.
So I hope that answers the question. That's the impression I got from it. If we need any clarification, feel free to submit. At this point, I do want to express our most sincere appreciation for our clients and contacts. During the most recent section, I received an email from one of our attendees that clarifies one of our items related to deceased employees. We're going to look into that a little bit further and include some follow-up if necessary, but there's a chance that based on some feedback from the state that if any payments made that are not subject to federal income tax, they would also not be subject to Illinois income tax. I'm going to look into that a little bit further, and I'm super appreciative of the information that was forwarded to me. So we'll include any updates in our follow-up. And speaking to that, as we've done in the past, I believe we will be making the recorded version of this presentation available on our website in addition to sharing the slides. So to the person who asked whether or not we'd be sharing all of the Q&A, if you refer back to the recording, you would be able to receive that. And we have a couple additional things to to mention, as we have a couple minutes while we're getting wrapped up here, I do want to just put in a brief plug. Our intention is never for our sessions to be a sales pitch, but for those of you who are not aware, Lauterbach and Neiman does provide, what we call a full suite of payroll services. So fully outsourced payroll, either remotely or on site. We do a full back office payroll processing. We handle direct deposits. We provide an employee self-service portal. We have additional tools as an add-on for timekeeping, scheduling, and HR management. And of course, any special project-based stuff or research. So again, just wanted to put that out there in case any of you were not aware of what some of our capabilities are. And finally, this second to last slide here has our contact information. So our three panelists today, myself and Wes and Erica, please jot down our email addresses. Feel free to send either individual emails or email to all of us with any follow-up questions, and we're happy to field them. And any feedback on the presentation or further topics, we do these trainings fairly regularly. We try to provide it as an add-on, a value add, no charge to all of you. And any topics that you would like to see us present on, please reach out to Jen Martinson, who kind of oversees this whole process. And I'll close with thanking you all for attending and hopefully getting a lot of value out of this. It's a hard topic to make exciting, but above and all else, we hope that it's been informative. So Wes or Erica, any closing thoughts?
Just want to say thank you to everyone and just ditto to what you said. Please feel free to reach out to any one of us or all of us with any of your questions you may still have.
Great. Well, thanks everyone again. Please stay safe and healthy, and we hope to see you all soon.